Hello traders, and welcome back to the Forex Kick. In today's video, we'll be breaking down a powerful yet often overlooked candlestick pattern known as bullish meeting lines candlestick pattern, and this pattern can signal a potential reversal in a downtrend or a pullback, offering you a strategic opportunity to enter the market at just the right moment. So by the end of this video, you will learn how to identify this pattern, you understand the psychology behind it, and apply it effectively to your trading strategy. So stay with me until the end, and you have all the tools you need to spot this pattern and use it to your advantage in your next trade. So without wasting any much of your time, let's get started. So let's start with understanding the pattern recognition. So the bullish meeting lines pattern forms during a clear downtrend and consists of two distinct candlesticks that signal a potential reversal. So the first candlestick appears as a long bearish candle representing continued selling pressure in the market. And I'm gonna take this as the first candlestick. It's actually usually a long bearish candlestick, and that signifies continued selling pressure in the market. And the second D, which is this one in the middle, presents a critical reversal signal. Despite opening lower than the previous day's close, a white or green bullish candlestick forms and closes at exactly the same price level as the first day's candle's close. So this precise meeting of closing prices creates the signature characteristics of the pattern. Either exactly or just a little bit, there could be discrepancies, but it should be very close to the closing price of the previous day. So key identification points to remember is that the pattern must form during an established downtrend or pullback, and the first candle must be red or black and relatively long, and the second candle must be white or green and close at the same level as the first. And the second candle's body typically appears completely below the first day's candlestick. And this formation differs from similar patterns like the bullish piercing line, where the second candlestick penetrates into the first body significantly, like this. Sometimes, let me delete this arrow. Penetrates into the body significantly like this, or like this. So the meeting lines pattern specifically requires the closing prices to match exactly or very close to the closing prices of the first day's candle, creating a temporary equilibrium between buyers and sellers. So let's hop on the charts and look for this. So this is Apple stock on the daily time frame, and I'm gonna try to look for the bullish piercing lines. You can see this one here, this long red candle indicating continued selling pressure, and you have the green candle open below it and continues to close almost exactly at the closing price of the first day's candle right here, and that you can see that close. So that is how to spot the meeting lines. You can see this was supposed to be the bullish meeting lines, but the difference between the close of the first candle and second candle is quite significant, so we can't use that. That's the bullish piercing pattern. We've done a video on that, you can go ahead and check it out. Look for another example. You can see it's in a downtrend or pullback, and that was why we are able to spot that. Another example is here. So we were bullish, then we had this pullback, initially bullish, had this pullback into this support level right here, and also below the 20-day moving average. So we're expecting a continuation. You can see this bullish meeting line here with the second day's candle closing almost exactly at the first day's candle. And after that, you can see price giving us the push to the upside to break structure and close above this high, above that resistance, and above that swing high right there. So let's talk about how to trade when you see this strategy. When you see this strategy, what exactly do you do? Do you just jump in, or do you wait for some type of confirmation? So a systematic approach to trading the bullish meeting lines pattern maximizes your probability of success while maintaining strict risk management principles. So let's break down the precise entry and execution methodology. Entry confirmation could be price must be trading below the 20-period moving average, and your RSI should indicate oversold conditions below 30, and also volume should increase significantly on the second candlestick. So let me just go back to this first example. I think I like this one. So if you can see the volume here on the second day, I see the volume on the second day was a buying volume and not selling volume, showing that yes, buyers are stepping into the market. That's the first confirmation. You can see price is well below the 20-day moving average. Also, if we add our RSI to this, let's see if the RSI is below 30 here. Okay, you see another confirmation. The RSI wasn't exactly below 30 here, so this was another indication that we might just skip this signal because everything didn't align. Just two confirmation checkpoints aligned. We had the volume, and also we had a valid pattern, and also prices below the 20-day moving average, but the RSI isn't exactly below 30 or very close to it, so we could just consider passing on this particular signal, or like the bullish piercing line where we had this, and also the RSI was below 30 here also. So you consider taking this trade, but you should also practice caution. You could enter at the opening of the third day's candle, and stop loss just below the bullish meeting lines, and take profit at a 1:1 or 1:2. I think it was able to give us a 1:2 trade before the reversal. So it's good to use your stop losses and use proper risk management. So this is another example where we saw the bullish meeting lines. You can see we were just a little bit below the 20-day moving average, but we were close to the RSI, the 70 mark on the RSI, showing that this price here is actually overbought. We shouldn't be looking to buy from here exactly. So, and that was how you had this getting violating this area right here. So, and that is one example. Let me just look for another one. This was another example. We had increasing volume right here, and we had price just a little bit under the 20-day moving average, but the RSI wasn't exactly below 30, so we could consider approaching this setup with caution. Could enter here, stop loss just under here, so, and take profit at a 1:2 or a 1:1, 1:3, whichever suits you. But you should be careful because the RSI was actually giving us overbought conditions, and we should be looking to take selling opportunities. So we could just ride with the RSI from the midpoint here to where it got overbought right here. So we're looking to take our profits. Immediately the market became overbought. So this was a pullback also. We were bullish, had this pullback in here, and that was where we got the bullish meeting lines before the continuation to the upside. So I'm just gonna look for if we have any other examples so that we can best explain this. Okay, there is one here. Now this one have there was continuous selling pressure in the market. You can see the rise in volumes corresponding with this gap, and then we had this the bullish meeting lines forming here. Price closed almost exactly with the first day's candle, and then that shows us that we should be looking for buying opportunities right here. So you can see the increase, you can see the buying volume corresponding, and you can also see the RSI being a little bit close to 30 right here, showing that this market might be oversold. You can see the price was also well below the 20-day moving average, 20-day period moving average, and taking a buy entry from there, we could look at stop loss just below the bullish meeting lines, take profit at this swing high or that resistance, or 1:2 or 1:3 risk to reward ratio. So that was how we would have been able to catch that bullish meeting lines setup. So remember to scale out of positions, taking partial profits at each target level while moving your stop loss to break even after the first target is reached. So alright traders, we've come to the end of today's video. You now possess the complete blueprint for trading the bullish meeting lines pattern effectively. Remember that success with this pattern comes from patience and proper execution, waiting for all confirmation signals before entering your trades. So if you found value in this analysis, make sure to hit the like button and subscribe to the channel. Turn on the notification bell to stay updated with more professional trading insights that will help you become a more confident and profitable trader. So see you in the next video, and until next time, happy trading.